A lower quarterly dividend often raises eyebrows, especially for investors who rely on steady income. In February 2026, FILRT REIT Corporate, or FILRT, declared a cash dividend of 60 centavos per share. That's a small but noticeable decline from the level investors had come to expect over the last 2 years. For those tracking closely, it's the lowest regular payout since FILRT's listing, and a clear signal of shifting dynamics. What's behind the drop? The answer tells a story of solid growth, but also growing pains. FILRT's underlying business is thriving. For the first 9 months of 2025, net income climbed nearly 15% year-on-year, thanks largely to the major addition of the Festival Main Mall. Total revenues surged by more than 20%, showing strong momentum, especially as the portfolio expands into retail. But there's a catch. The acquisition of Festival Main Mall wasn't funded by cash or debt alone. Instead, over 1.5 billion new shares were issued to the parent firm in exchange for the property. This boosted the company's absolute earnings and distributable income, but by expanding the share count, it diluted the dividend per share. Put simply, the pie grew, but there are now more slices to go around. Despite higher profits, per-share dividends eased to around 20 centavos for the first 9 months of 2025, down from 25 centavos the previous year. This trend reflects a longer-term downward drift, with regular payouts inching lower since 2022. Looking ahead, FILRT's management has charted an aggressive path. Their strategy prioritizes scaling up the portfolio, with new assets from both within and beyond the FILRT group possible. Acquisitions will be funded through a flexible mix of debt, equity, and property for share swaps. With relatively low leverage, FILRT can borrow more, but continued share-funded growth means dividend per share could stay under pressure even as total earnings grow. For investors, this marks a shift. FILRT is moving from a pure yield vehicle toward a growth-focused REIT IT. The hope? Better assets, stronger cash flows, and eventually, a rebound in payouts. In the meantime, income may be stable but muted. The future shape of dividends will depend on how new assets perform, and whether management leans more on borrowing or new shares to fund growth. For now, understanding the story behind the numbers is key. In a changing environment, those who stay informed are best positioned to adapt.